Ladies and gentlemen, good day and welcome to Q1 FY24 earnings conference call of 3i Infotech Ltd. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Asha Gupta from ENY Investor Relations. Thank you and over to you.
Thank you, Yashashree. Good afternoon to all of you. Welcome to the Q1 FY24 earnings call of 3i Infotech. The results and investor presentations have already been mailed to you and you can also view it on our website at www.3iinfotech.com. To take us through the results and to answer your questions, today we have top management of 3i Infotech Ltd represented by Pankaj Ganam, Managing Director and Global CEO, Sushant Purushan, Chief Operating Officer, Enterprise Services and CRO India, Sax Krishna, Chief Operating Officer, Digital and Next Gen Business, Harish Shenoy, Chief Operating Officer, Professional Services and Chief Risk Officer, Sanjay Rava, Chief Financial Officer, T.S. Mohan, Chief Human Resources Officer, Marika Rastogi, Company Secretary and Legal Head. Pankaj will start the call with the business update, which will be then followed by Sushant, who will provide us an Indian and Enterprise Services business update. Sax will provide the update on the value business and New Bharat Rail project, and then we will open the floor for Q&A session. As usual, I would like to remind you that anything that is said on this call that reflects any outlook for the future or which can be construed as forward-looking statement must be viewed in conjunction with the risks and uncertainties that we face. These risks and uncertainties are included but not limited to what we have mentioned in the prospectus filed with SEBI and subsequent annual report that you can find it on our website. With this, I will now hand over the floor to Thompson. Over to you, Thompson.
Thank you, Asha. Hello, everybody. Good day to everybody. I will begin the summary of this quarterly results and brief you about the business events that have occurred during the quarter and outlook on the macroeconomic situation as well. For the first quarter of financial year 24, we registered a revenue of 194.4 crores, representing a growth of 8.5% year-on-year and 2.1% quarter-on-quarter. Our gross margin from the business was 16.5% during the quarter. The growth was driven by continuous effort and consistent effort to establish new services under the New Ray brand, which drives our digital and next-gen business and to expand in other new sectors and new industries. The goal since we executed the carve-out was to build a services business which is sustainable and profitable in the long run and drive to positive EBITDA. And I'm happy to inform that the quarter we achieved our milestone with a positive EBITDA of 1.3 crores minus the RailTel large project. So for us, though the results in EBITDA are negative, but from a business model perspective, in our effort to build sustainable profitability, this is a very, very important milestone for us, where we are aimed to hit our first 1.3 crore profitability with all our lines of business of run, grow, and next-gen businesses. So this is an important point for us and an inflection point for the organization. And we hope to build on this momentum and to build on sustainable, profitable model for this year. And as for us, we are building a year of execution excellence, which is our focus area for this year. During the quarter, we've been adding 32 new contracts or lines of businesses with existing and new customers. It's a very important part for us as we build this business. These new contracts will be very, very important for us to grow these revenues positively and also to bridge the erosions we have in some of our geographies, especially in some of the western geographies where there are severe headwinds, which is the industry is facing overall. The revenue mix shift is also happening very clearly. If you look at it from our volume and a value mix or our run and grow mix, which we have been consistently using for the last 2 years, a very clear shift is happening where our value businesses and our premium volume businesses are all starting to drive growth very steadily. Also want to quickly talk about a few highlights and business events, and I'll probably allow my other colleagues to expand on it in the paucity of time. Our new Bharat network is commercially ready, which is our RailTel project, and we are launching our mobile app in August 2023, which will be a very, very important milestone in a journey to build a super app and build sustainable revenues. And I would probably, on this point, probably I'll just touch upon some of the last 6 months. We've been busy trying to ramp up this project, and the pre-operating cost and the minimum guarantees for Q1 had been taken up in Q1 as part of the overall project plan as well. And I'll allow Sax to expand on this particular project when he talks about it. New Ray Future Tech is one of our flagship IIT Tech Park. We've been constantly investing on cognitive computing and AI related products and platforms, which also enables and drives next generation services in terms of prescriptive and next best action. I'm happy to announce our first paying customer for our CXO DSS Digital Support System product platform has been acquired, which will offer prescriptive and next best action effectively. And this is for our credit union customer in US, and then now we are expanding into healthcare in UK as well. So this is a very extremely important milestone. We got our first 400K order, which is a very important milestone. This also will change dramatically the entire profitability mix as well. And also, we've also got our first customer for our predictive and prescriptive analytics and demand forecasting product as well, which is also a very important milestone, and Sax will expand on this. With regard to our digital infrastructure management services, it's been a main spearhead of growth in Q1. There are multiple large deals we have acquired, and now we need to see how we can leverage this growth momentum, not just in India, but also to see leverage how can we leverage this globally as well, as some of the other lines of businesses across the world are slowing down. And I will request Sushant to expand on it once he comes to talk about this. And also, we also quickly had some good wins in US in our existing customer space, where we have been able to add new lines of businesses to the tune of almost 2.4 million TCV, where we have been able to add cognitive computing, and also the first time we have done a customer experience transformation for our existing customer, and Sax can expand on it more in detail. So broadly, from an overall environment perspective, if you look at it, North America and US is going to be a challenge for the entire industry, and we are no exception to that. And it's very importantly, we need to quickly, change the revenue mix, because some of the traditional lines like professional services or human capital management are under stress across the industry, and we are no exception. And there is definitely degrowth which is happening there, and we need to figure out how to bridge those gaps. And even our results are, we look at it very positively, because relatively it might look only a 2% growth, but the net growth is there still in spite of erosions which are happening in some of these territories. So that's the way I would request the shareholders to look at the overall performance. And then probably if you look at it, and some of the other key points would be there are certain other issues in terms of the P&L and balance sheet items, which I don't want to expand right now. Maybe we have some questions which are there, and effective questions. So probably what I would do is I would pause here, and maybe I'll allow my other colleagues to expand on some of the points I've spoken, and then we'll probably get into a more detailed Q&A and questions where we could probably answer some of the results and some of the other very specific financial aspects as well, where Sanjay can come in and expand on that. I'll pause here, Diwakar and Asha.
Sushant?
Yeah, Asha. Hey, thanks, Thompson. Good afternoon, everyone. My name is Sushant here. Let me just give you the enterprise business, which I drive has three important business lines. One is digital infrastructure services, then digital BPS, and e-governance business. So, coming back to Q1 point of view, I would like to highlight what we have done in Q1. It's a good Q1 for us. We have overall closed around 40 crores of order book ACV and 100 crores of contracts. Out of that, three important contracts I would like to highlight in this thing. First, we won a very significant deal from Indian Oil Corporation that is predominantly for a data center contract. This is a new contract addition to what we are supporting all their branches and outlets. This contract gives us value to us because we are managing their core applications that Indian Oil Corporation runs, which is predominantly an Oracle, their refining application, their billing application altogether. So the key area for us to maintain their data center 24/7 and provide the value to them. This contract is typically a 14 crores contract for 3 years, and which is moving us from our edge support to a core support to the line. Next, I would like to mention we picked up one of the significant contracts from one of the private banks in India, fourth, the fifth largest in private bank. This is one of the significant contracts because we will go to manage their core banking data center operations, one of the significantly important sections within the banking network. We're going to maintain the data center operation which runs the TCS core banking applications and all the applications which are residing in Mumbai and Hyderabad as well. So this is a contract is somewhere between 45 crores contract for 2 years. And the good things to know that we have gone live in 45 days and incumbent was Wipro here. So we've gone live in 45 days, which is one of the significant milestone, and now we are moving into a transformation phase of this contract as well. The third important contract we have won in this quarter one is from an enterprise vertical, where we have not been present there. That is called Bajaj Electrical. We have won the contract in Bajaj Electrical to manage their digital infrastructure services, cloud, security and network and various other operations out there as well. This is also a significant contract because this enables us to get into their enterprise segment. We are also managing their dealer and distribution network as well. This is around 19 crores contract for 5 years, but it's a great breakthrough for us. But what we'd like to bring here is all of these contracts we fought with the MNC players like in IDFC we have NTT, Kyndryl and Wipro. Bajaj Electrical have an Accenture, Kyndryl. So basically, we have been elevating ourselves, into a tier 1 player in this space, and we look forward to percolate the growth in coming quarter as well. We have some more successes also in the second contract. We are in the advanced stage of closing few, and I hope in days comes we're going to announce that as well. This is my brief side from my side.
Hey, thanks, Shashank. And maybe Sachs, you could probably get in and talk about the progress in digital and next-gen business, and especially expand on the NBN as well. Okay.
Absolutely. Thank you so much, Thompson. I'm so delighted to be addressing this audience today. Thank you very much, everybody, for the time. I have two kind of narratives here, as Thompson mentioned. First, let me take up the Nurid Bharat network, the RailTel collaborated Wi-Fi monetization project. It's a very interesting project, and accordingly, there's a lot of interest from the market and shareholders. Let me address that first. There are two sections of updates I'd like to give on this business. One is the tech update, because it's a technologically led proposition, which is how we got into this partnership with RailTel. And the second aspect is how is the business getting acquired? How are we truly monetizing and going way beyond the minimum guarantee that we've committed to RailTel? So on the tech update, our initial approach going in was to leverage the existing assets of RailTel, which obviously was not tuned for this level of monetization. So we had to go ahead and develop tech stacks ourselves. There are 3 tech stacks we're developing, and I'll come to each of the stages. One is the ability for people to land on the mobile to a page which can then be the driver for monetization through ads. So for serving advertisers and putting those advertisements on that platform. That's called Captive Portal. The second is what we call the AAA server, which is another tech stack which is required to authenticate and drive the user to the particular page, whether they are an authenticated user or a new user. The third is the ad server, which actually serves the actual ad by its size, whether it's video or still ad. So these are mainly 3 tech platforms that we had to put in. Obviously, like any other tech platforms where there is no precedence. This is a platform which doesn't exist at this scale, 6,100 stations, 23 million travelers, 1.2 to 1.6 million logins, unique logins every day, is not a scale that has been addressed in the industry. Forget India, even in the world. So obviously it took us some time to understand the complexities and the vagaries. We have gone past all of that, and now the status is all these three platforms are the captive portal is already on, like Thompson mentioned, it's already gone live. We are fully operating for business. If any of you gentlemen go to any station and click on the SSID called Railwire, you'll actually see our platform working with our logo also on top of it. So you can actually experience what I'm saying in words. That's the captive portal. The second platform is the ad server, which is also fully integrated, so it's on, so it's able to serve ads. The third platform, which is still placed in the final stages of testing, and that should go into production in the next 7 to 8 days. So we're fully equipped, if you may, from a tech platform, tech stack perspective, because it collects data, and the data will then be used for analyzing what kind of users, what kind of eyeballs are we targeting, and therefore bring that back to that sector. So that completes the ability to deliver the value proposition that we originated and assumed going into this partnership. So what are we doing with these tech platforms being ready, right? So that's our go-to-market strategy. There are really 4 channels of go-to-market that we're focusing on. Each of them will have various degrees of maturity as we speak. The first channel is what we call programmatic ads. This is what comes from Google. Places ads, as you all know. If you're a Gmail user, you'll have those pop-up ads coming in based on the emails you're browsing or the sites that you're browsing. It's the same concept that Google will serve ads on our platform too, for which there was an integration required with Google, which we have done. It is getting now into the flow of bringing in those ads. Just to let you know, Google Ads platform comprises approximately 80% of all ads that are ever placed in the world. So we're integrating with that. We're also integrating with other SSPs, sales-side partners, as the industry calls them, besides Google, to get the programmatic ads in place. What the beauty about this is, it's non-linear, it's not human-centric. We don't have a sales sheet on the street to be able to get these ads, so they can scale very quickly. The second channel is going and attracting large enterprises / PSUs, because they do have a lot of budget, they do have a lot of messaging that they need to take to Bharat, which is a unique proposition of this platform. So we have close to 50 plus crores of pipeline at various stages of closure with the PSUs and large enterprises. These are direct sales, these are based on relationships, and they are very, pretty advanced stages of closure from a pipeline perspective. The third channel is what we call direct ads from medium to semi-large enterprises. This is a very, very large market which is made up of local retailers and small enterprises pan-India. In order to cover this market, we need an innovative sales approach, not the conventional feet in the street, because the model won't sustain the sales cost. So what we've done is we have put a virtual sales organization, which is far less expensive, which will sell without actually meeting the customer, certain type of ads, certain type of customers, which is one channel. The second channel is a direct sales organization, very minimal, but again, going after some key accounts that we can convert them into ad revenue. The fourth channel, which is also very, very compelling, is the OTT content monetization. So what we've done is we have started partnering and onboarding and orchestrating content from various OTT players. But what is most important is we've developed a blockchain-based OTT orchestration platform, going back to our tech bias towards the business. We're deploying a blockchain-based OTT orchestration platform, one of its kind, doesn't exist in India. In fact, once it becomes successful, we're going to take this to all media houses across the globe. It's that powerful a platform. But we're using that to monetize OTT content. So your typical sachet, if you may, 25 rupees for 30 minutes of OTT content. Kind of an example of how you can place ads and how you can gain money from the OTT platform. So those are the 4 channels of business or revenue that we're going to generate. So the minimum guarantee of 14 crores that we have to pay to Raintel can be easily served just by the one channel of revenue, which is the PSUs and large enterprises. I mentioned the pipeline of 50 crores. That alone can service the minimum guarantee, but all the other lines of business just scale way beyond that, which is the original proposition of this enterprise. So that's on the New Red Bharat Network, Raintel, kind of an update. Let me move on to the other aspects of our business, which is what we're calling a value business, or we're calling digital business and next-gen services, which is made up of multiple business lines. If we start with cloud first. So cloud first is a big arrowhead for us right from the time the carve-out happened. We had designed that. And cloud first for us being transformation in cloud infrastructurally and transformation in cloud from a business impact perspective. So both those large narratives, if you may, have been broken down into specific products and services that are going into the marketplace. And we've already got enough customers that are gaining now both from a either security product all the way to cloud adoption in the box. So I'll talk about the numbers that it is contributing, at least from a percentage perspective, so you can get a fair sense of where this is going from overall business. The second business that Thompson mentions is our new Future Tech, which is into cognitive computing. We have really taken that into 2-3. There are many use cases for cognitive computing, obviously, but what we're taking is offerings which can be replicable, which can be scalable, which can go across the globe, not just in one region. So we're developing a demand forecasting system for a utilities company, which is a very unique problem. So dynamic demand forecasting, which we can then replicate across gas and utility companies, across the globe. We're taking what we call the actionable decision support system. Otherwise, we call it as a CXO cockpit, which, like Thompson mentioned, we've won our first order. There are few more which are already in the advanced stage of pipeline. So that business is kind of, as they develop IP, it is also becoming accretive in terms of getting paying customers. Yeah. So that's the second line of business. The third line that I like to highlight is our digitally intervened business process as a service, where we are utilizing again insights based on analytics in an interaction center, in a call center, in a tech support center, in an outbound sales center, or we are taking a claims automation platform and merging that with the actual claims adjudicators so we can get better value to our customers. So that's the second line of business where we're gaining traction. We already have one of the largest TPAs in India as a customer for the claims management process that I just talked about. We also have banks that are coming up with us for doing their collections and outbound sales for CASA, as well as taking up their inbound customer support for offerings like FastTag. So that's a growing business for us, and that's going to grow as we go through this year. The last but not the least is our consulting business, which is we term it as New Mass stuff. That is becoming a naturally in digital transformation. Most engagement start with consulting, and this unit is helping us as a spearhead, as the first landing port, if you may, for our prospects and customer engagements, where they define the plan of digital transformation, where they define the plan of what they need to achieve as a business outcome, which then drives vertical products across the business lines, whether it's applications, it's a cloud, or DigiBPS, or Future Tech. So that's kind of the update, if you may, and I'll wait for questions and I can answer them directly on our web here and pass the microphone back to Asha Divakar.
I now hand over the floor to Mr. Divakar Pingle. Please go ahead.
Hi, this is Divakar. I think before we get on to the Q&A, just want to kind of bring to your notice that post the results declaration, I think a bunch of you investors who have been closely following the company and some of you who have been long-term shareholders have sent us a lot of questions. So in the interest of transparency and to ensure that the other participants on the call also understand what those questions are, what we thought was we're going to kind of read out those questions that have come by email to us, including naming the person that has sent us the email, Thompson and his team will actually go over trying to explain to the best extent possible as to how we are addressing that or what the issues are. And post that, once those questions have been answered, maybe some of you will get a fair sense of what the background is and how the company kind of taking action. Post that, we'll kind of throw it open to the general audience here for the Q&A again. So with that said, I'll hand over the floor to Asha. Asha, if you can possibly first state the name of the investor and then state the questions one at a time, which Thompson and his team can answer, and then we'll move to the next question. Thank you.
Sure, Divakar. Thank you. So we'll start the questions received from Purushottam, an individual investor. First question from him is, in FY22, 3i team made huge provisions to cover CDD, approx rupees 160 million in Q2 FY22. While during the call last time, he raised an issue and he was told that while 3i will collect this money from market, but we are not just providing it from compliance perspective. I was also told that at least 50% of this provided amount will surely be collected. Till date, there is no trace of what happened to that excess provision and reversal. Similarly, there was double provision for employee bonus made in Q2 FY22 with the justification that we are changing the provision norm for this year onwards and henceforth we will provide the bonuses for the current financial year in advance. As a result of that, Q2 FY22 earnings took a double hit of bonus provisions. If this was correct, then the base effect of this double provisioning should have given positive impact on profitability in corresponding quarter in next financial year. But the same never happened. Over to you, Sanjay.
Thanks, Asha. I'll take the first part of the provisioning to just get this addressed. Out of the amount that was stated in the PDD of 16 crores, we have collected the stated amount of more than 50% already as we speak in Q2. The further plan I would like, push Sushant to get us through with what's the plan. I'd also like to go through in the meantime the second part of the question, where we have said we have taken a double hit on account of bonus provisions. We have actually provided the amount that was approved by the board as part of the provision in the relevant years. So it's not that we have taken a double hit in our books. So that's the question that, it's an incorrect way to kind of reflect. I'd anyway like to answer to Purushottam on a specific point that he may have on a one-on-one call to get this addressed. So, Sushant, can you take on the doubtfulness provision first?
Yeah, so, yes, Ajay. Yes, I understand we are focusing this as a key area. One of the largest transactions in this provision PDD was Bihar Planning and Development, where there was in 2019, the amount was being held by that department. We have moved to seek the legal option here because there was a discussion happen and it's going in the right track right now. There are first time that the first hearing has come up and we're hopeful that will go to clear us because once majority of 25% of the balances comes from this particular department as well. There's one more significant improvement happened. There was a Ranchi Smart City project we executed through a consultant called Stup Consultants and there is a good discussion happened. And they have agreed to forward to pay us on that basis or pro rata basis. So having said that, yes, we'll be closely working on this to ensure whatever is recoverable from us will be received in coming quarters.
Thanks.
Thank you. Second question from Purushottam is, billing rate of 3I in on-site geographies is even lesser than the minimum wage norms. How is that possible? Special mention of USA billing rates here. There seems to be something terribly wrong happening in the US billing. The billing rates and the cost of resources always move in sync, but this equation in case of 3I is completely out of sync. I have highlighted this issue of per person realization issue many a times in earnings call, but I have never got any satisfactory answer till date. Over to you, Thompson.
Yeah, so I'll take this question. I think we have discussed about this as well multiple times. Maybe like what Sanjay said, we need to have a slightly deeper industry level conversation. Maybe we cannot solve it at this particular call for sure. Because we need to get on the same page on where 3I was 2 years ago when the carve-out happened and when slump sale happened and what was the residual business. It's very important for us to understand that. And I've told this multiple times as well, this cannot be compared with any other industry peers because 3I was never a services company. What we are building today in the last 1-2 years is a services company. So there cannot be any parallels on this in terms of any tier 1 or any tier 2 established players in terms of billing rates or whatever. Because a lot of the businesses in US, as I've been telling consistently, these are onshore businesses, nothing to do with offshore. Even in onshore, we have lower billing rates because you might be doing a subcontractor work for another player. Obviously, there are thinner margins and there are even more headwinds right now in terms of the pricing pressures there. So that is the impact. I think we need to have a more detailed conversation. Asha and Divakar, I would probably say that we should have another meeting where interested people in the industry and the next level of conversation are more than happy to discuss it in threadbare. And I think to get on the same page. Yeah.
Sure, Thompson. Thanks. Third question from Purushottam's line is, exchange fluctuation benefits or loss in case of 3i in 3 quarters has been abnormally high, approx 20% of revenue, whereas this figure for all other companies is always less than 1% of revenue. Even if we look at 3i's past record, the exchange fluctuation impact has never been so high. We never got any satisfied answer for this issue. Suddenly in Q1 FY23 results, this component has come down drastically to standard levels. So how is that possible? Sanjay?
Yeah. Let me. So to answer to this point, our exchange fluctuation for last year has been less than 10%. So I'm curious to understand how this is at 20%, which has been stated in this particular note. Further, as I briefed in our early call as well, we had amended our FTTR policy last year, which stated that our foreign exchange translation, which was earlier happening on the basis of an integral operation, has been changed to a non-integral operation. So which is more primarily to do with the way our subsidiaries work in alignment to, so subsidiaries are even more, I would say, operating guidelines for them to operate on their own. So this is how we had instituted the non-integral policy, which has led to the exchange gain of this amount. And I don't see this happening at a large scale now going forward, because this was due to a one-time adoption of this policy. For the current year, we would find the exchange gain to be in line with earlier in other, I would say in line with in the like companies. And we are revisiting our hedge policy for the current year, which would be in place by Q2 end.
Thank you, Sanjay. Next question is, despite getting new orders and also the inherent escalation clause in manpower contracts, why there is no revenue growth happening? The single-digit revenue growth reported by 3i in rupee terms gets automatically done even with the devaluation of rupee that has happened in last 12 months. So where is the growth? What contracts they are losing, and what is the overall revenue impact on that account is just not shared, so there is no revenue build-up confidence coming up from management. $1 billion carrot has been kept far away in 2030. So till 2030 arrives, no one knows how that revenue will happen when the last 2 years the growth has been 9 to 10%. Over to you, Thompson.
Yeah, thanks, Asha. So just to kind of expand on this particular question from Purushottam, is very clearly there are 2-3 aspects of it. We have kind of broken our businesses into professional services, which is your traditional HCM business, which the entire IT industry does that. The enterprise services, which Shashank spoke about, and the value business or the digital business or next-gen business, which Zach spoke about. What we inherited as a team last 2 years ago was predominantly the volume business, which was predominantly professional services, or a volume side of the enterprise businesses. That's where it is. So if you look at it, a revenue mix change has been happening, and systematically. The first year was where we are building all these new lines of businesses which never existed. So that I think every shareholder should be first aware of and be very clear, because year one was the year of building these new lines of businesses. Forget about building new products and platforms. Being in parity to compete in the market, even in your enterprise services and digital businesses, takes some time because it was not readily available. So year one was spent only on retaining your existing businesses and doing it. The second year today, if you look at it, where we have completed last year, is where truly the revenue mix change is happening. And you will see in our segment reporting as well. In fact, we are changing our segment reporting into more details from Q2 onwards. I think Sanjay is working on that, where we'll have more expanded segment reporting. So it has very clear clarity in terms of what was the old traditional business we inherited, where it is today, and what are the new lines of businesses, how are they growing, what are the next generation businesses, where their margins are going. At least if you look at our segment reporting right now, if you look at our cloud first business, which is one of our new lines of businesses, very clearly, if you see, there's a very clear upward, movement which is there, and you see the gross margin movement in that as well. And similarly, the next generation business, which is now starting, which Zach spoke about, all this will start showing a huge margin change which will happen. Specifically on the revenue terms, yes, of course, we are facing pressure in US in terms of the professional services business. There is pressure. There is definitely there's pressure. We are not running away from it. We spoke about it. We had impact of green cards in the last quarter, 2 quarters. That is definitely impacting us. And there is a huge slowdown in the American market for sure. Every company, I think, Q1, you take tier ones today, I think the first time in the history of this IT industry, there is degrowth for even a tier one player like Infosys. TCS has grown in the lowest in the last 25 years, I guess. I think this is very real time, and a relatively small player of us, we are not insulated. We are still fighting back. We are trying to put back these revenues very, very clearly, and that's where the net growth is there. Still, we are not degrowing, and we are going to stay to our outlook, and we'll make it happen. And we will definitely come with you don't have to wait till 2030 for sure. We have given our 3 years, 5 years forecast as well. So one of the things, Asha and Devaka, what we'll do is we'll put together a note here for our shareholders and investors, maybe in a week's time as well, and we'll upload it into our investor portal, which will have clarity towards all this as well. So in terms of detail, in terms of what is the revenue mix change, what is our medium-term goals, how we want to achieve this goal, we will try and put a kind of a PowerPoint, which even we probably had shared with our board and other things. We will try and articulate that as well as how we have moved it from the exit of 2021 to where we are today, what is the changes which has happened. And so there are a lot of these old questions which keep coming back in your questions as well. So we might as well, we'll probably have one FAQ answer put through there, which will probably help everybody. Yeah.
Sure. Thanks, Thompson. Last question from the Purushottam's mail is, if KMPs of 3i have been so bullish about turnaround of 3i, why none of them have exercised their ESOP till date? I presume all of them negotiated from ESOP as part of their compensation before accepting the employment offer. Now, since we have started building pressure, Thompson is assuring that he will exercise some part of his ESOP. This is totally insane. I have never heard a case where other shareholders drive KMPs to exercise their ESOPs. Over to you, Thompson.
No, fair question. I think we spoke about it in the last meeting as well. So this is not a question of, I think we have to set the baseline right, okay? 3i is a very unique organization because we don't have a promoter, stated promoter. All of us have worked in multiple industries for a long time. All of us have exercised our ESOPs in our careers. It's very, very clear. We have all been part of all this. I think we should all be on the same page. This is the first time we have a small cap to a small to medium cap company which doesn't have a promoter. So we have to be sensitive to that actually. Very, very similar. So the responsibility and accountability of the management team is enormous. And then I think I expect every shareholder to be sensitive towards that. It's very, very important for that because it's a very unique scenario. But all said and done, but definitely me and my management team, we will now execute this. The points like what Purush spoke about, we will do that to show that how we are committed, because we all signed up in this organization as entrepreneurs and entrepreneurs trying to turn around the company in the absence of a promoter. So we are sensitive to that, and we will take accountability for that, and we'll do that. And we also help and hope the same reciprocation from our shareholders.
Thank you, Thompson. We will take next question, which we have received from Madhu Kumar, an individual investor. His first question is, the business plan and projected figures are not matching with reality. For example, you have promised a PAT of rupees 30 crore for FY23, but we ended up with almost nothing. The plan for the business you promised was $1 billion in 2030. But at the rate of 8 to 9% growth YOY, it seems to be far away in reality. The PAT for this financial year was projected more than the financial year in FY23, but Q1 started itself with 16 crore loss. So my question to you is, are we projecting the business based on some facts or figures that are plucked from the air? Over to you, Sanjay.
No, I'll try and first answer that. I don't think any of us, pluck any figures from the air. We are all serious businessmen, and I expect the same reciprocation from our shareholders as well, very, very clearly. To state the facts, I will go one by one. One is we never told a PAT of, even when we did the last year, we did an outlook and a guidance, we never gave a PAT number. We said we will hit 760 crores and we will do an EBITDA of 30 crores. That was the stated things. Recordings can be taken, facts are available, please look at it. I don't want to discuss about the variables which hit us from the past or whatever it is. The reality is reality. We are taking that head on and we are trying to turn around the organization very, very clearly. So that's factually incorrect. That is point number one, Mr. Madhu. I think it's factually incorrect. The second point is very clearly, we spoke about this $1 billion thing. Post the carve out, when the company had no vision, mission, products sold, which was left here, we had to set a direction. It's a direction for the organization. We can be, we can be naysayers to that. That's different. You set a direction where all of us work together and move towards that. The second part is how do we do that? Even that I have repeatedly told about it, and we are executing it systematically. I told it I think we should also probably, this is like a repeat every time I keep talking about it. The traditional business is never going to get there. No way it is going to get $1 billion. Traditional B2B business will get you only year-on-year growth wherever it is not going to get there. We spoke about B2B2B. We have revenues which are there, which we will probably articulate in our segment reporting as well, where we'll say how to go. B2B2C, we have already demonstrated that. We have got into this large project of Nure Bharat network. You wait and watch. You wait and watch how this revenue is going to happen. That is the answer for me in terms of, all the naysayers in terms of how this is going to get to 1 billion. I'm very clear about it.
Thank you, Thompson. Next question from Madhukumar is, I see accounts payable more than 1,000 crores and receivables around 369 crores. How did this happen? Whom we have to pay? You always say it's a debt-free company and auditors say a different story. Can you give clarification for this? Over to you, Sanjay.
Yeah, so these are old intercompany outstanding balances for which we are in the process of filing our application to RBI for set-off of the old balances. I think we did state that in our earlier calls as well. So this would get done now. We are in the final stages of processing our application with RBI, and this should get done by Q2 of this year. Further, I would like to update that we have already formed a subcommittee of the board for reviewing and taking necessary action for legacy-related matters, which is chaired by our audit committee chairman, Mr. Uttamji Agarwal, and we are further looking into the matters so that we can get this addressed in total.
Thank you, Sanjay. We will take next question, which has came from Shrikant Kamath, an individual investor. His questions are, the company's other expenditure is rupees 30 crores. Is it an investment for future development?
We do not have such an amount of 30 crores under other expenses, so would like to get more details in this regard.
The next question from Shrikant is, the company owns the office or it is a leased one?
So we have our own offices as well, which is at Vashi, wherein we do most of our BPO related work, and we had this earlier given to Azinsho, which had gone back to us in the last year. But all our other offices for corporate here in Mumbai and other offices, area offices in India and abroad are all leased.
Thank you, Sanjay. I will hand over the floor now to moderator for opening the Q&A session. We have finished all the questions taken from the emails which we have received from the investors. Thank you. Over to you, moderator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Atmaram, an individual investor. Please go ahead.
Yeah, I hope I'm audible, Mr. Thompson and team. My question is, I'm an investor since 2010. Very, very frustrating. I hear tall promises. Previously, I'd asked a question on employee cost. Employee cost keeps growing. It's almost 70-80% of your entire revenue is your employee cost. Is it so difficult to rationalize the employee cost, identify where you are in excess, where you are actually spending your manpower? Why is it not why is it so difficult for years together? We keep on having these expenses so high. I had asked you the same question 9 months back. And after 9 months, I'm still having to ask the same question. I hope I don't get the same answer.
So, Atmaram, so what I will do, I'll allow my HR head to talk about us because he is driving some of these initiatives. On a broad high level, I will say definitely I agree with you. For a services business where we are today, the biggest component is human resources. We have to continuously keep optimizing it, and we are doing that systematically. And now in an age of generative AI and large format, this is going to get disrupted very, very, in a big way. And we are also preparing to do that as way forward is there, because whether we like it or not, technology is changing. It's going to change the way the mix of the business is going to happen. That's for sure. But definitely we are. I'll allow Mohan to expand on exactly what steps he's taking to optimize and rationalize this. Mohan, if you can step in, please.
Sure. Thanks, Thompson. Hi, everyone. I'm glad connecting. So very quickly going sharp into that space. It's a good observation. In fact, we've been working on since the beginning of this financial year. We have identified pockets of rationalization without impacting the business, and also continue to fund for the growth. So it's a fine balancing act we're trying to do. We have identified wherever the opportunities in terms of span rationalization, in terms of redundancies existing because of the technology changes, and we have in fact taken actions, and we expect to see the financial outcome of those actions trickle down from Q2 onwards. So we expect that employee cost as a percentage of revenue to rationalize to the extent of at an overall company level to 76% from 78%. Yeah?
If I can just add, I asked the same question 9 months back. I got the same reply. I don't see any change that's happening in the numbers because you say employee cost as a part of revenue in these days, wherein first of all the number of employees in these days of AI and ML, is it really required that you have so many low-end employees in your entire structure? It's something that I've not understood. These are all very general answers that I get. Probably my frustration will go to an extent that I book my losses and get out after 12 or 13 years of being with this company.
No, fair question. So I think I'll take a step back. I think it's important for us to understand the nature of the business variance. We are currently, for classical as many number of years, even before 1.5 years back, we've been organized as a business of BPO services and classic infrastructure services and front-end application services, which are extremely employee-intensive operations. We started making the shift in the last 1.5 years. So I want all of us to come back to that shift which is happening as of now. So as we see, our revenues from the newest technologies have started trickling in now, and then rationalization in terms of the classical business. So we cannot suddenly shift the entire business cycle for the purpose of its growth and stability. So we continue to see the growth engine coming up, and our investments in people are happening in the growth engines. So I'm more than happy to have some short calls to see where we are investing in people in new technologies and new business areas, and how are we rationalizing low margin classical businesses while we continue to sustain them. So I completely share your answer, and my expectation is if you can continue to keep observing down the line next 12 months, you will be able to see significant changes.
Okay, thank you.
Thank you. We have our next question from the line of Narendra from Robo Capital. Please go ahead.
Yeah, thanks for the opportunity. So, given the headwinds in the Western markets, are we still looking for a 1,000 crore kind of revenue this year, or are there any shortfalls that you see there?
Revenue 1,000 crores.
Sorry, can you kind of couldn't get it? You're saying some Western. Can you repeat that if you don't mind, please?
Yeah. So I was saying that if I see in your presentation, you have guided 1,000 crores for FY2024, or we have set the target of that, I guess. So, given the headwinds in the Western markets, is it still on track, or are we seeing any shortfalls there?
No. So, Narendra, just to set a context right, when we started 2 years ago, we set a goal saying that end of 3 years we'll be at 1,000 crores is where our short-term goals which we set for ourselves. Last year we exited, we were planning for 760 and we exited at 730. But we had a good order book which we are now trying to execute this year. So if you ask me, our target will be to cross 850 this year, and I clarified in my planning call also that when we quarter end we said that we want to exit this year with a 1,000 crore run rate per month. So that is a clear target we want to do, so that when we exit this year we want to at least have a 1,000 crore order book, not revenue, just to clarify.
Okay, got it. And any comments on the margins that you will be able to do in the next 2-3 years, if not short term then?
Yeah. So even just stay focused on this year. If you look at it, even the previous question which Mr. Atmaram asked also, see, one of our biggest pressure is to change the margin mix, which we have been struggling, and we are slowly seeing that. If you see a quarter on quarter and a month on annualized trend, we are already at around 16% in the gross margin levels. We want to take it up to almost 19-20%, which is very important for us, by changing it. Like what Mohan said, we need to change this value mix. The volume mix is almost, to the lower margin levels and the value is higher. And now as the revenue mix is changing, we'll see the change of that. So definitely we want to target 18-19 for this year and a more share of at least the value business, which has an average of 25 to 28% GM, which is there for us. And that's the kind of direction we want to take, Narendra.
Okay, thank you so much and all the best.
Yeah, thanks, Narendra.
Thank you. We have our next question from the line of Sanjay K, an individual investor. Please go ahead.
Hi, Thompson and Sanjay. So, first of all, we have seen the revenue and there is a growth of 2% plus and a good mix of good increase in grow revenue. And considering the situation in market, and we have seen a lot of IT companies have shown a degrowth in revenue, and still CI Infotech managed to get 2% plus increase. So first of all, well done to your team and good work. Though we are expecting more increase in revenue and definitely margins. So my questions about one is how the cash flow looks like for the end of this quarter. Last quarter it was about 61 crore and the cash flow situation now, and the office space, which was again I think last call you mentioned that the office space something got from Agentio is still need to be utilized, returned, or to be sold. So what's the status on that? And second question is about RailTel project. I think SAC has given some update, but how the situation is now? Are we going to get any revenue in this quarter? And how many any big advertisers have been signed off, or how the situation in next 2 quarters? How we are looking for the revenue from this RailTel project?
Okay, very great. Thanks for the kind words, Sanjay. And I'll allow Sanjay to speak on the cash flow and the Vashi property, and then I'll kind of expand on the other questions for you.
Hi, Sanjay. Hi. Thanks for the question. Let me give you a view of our cash flow that we as of 30th of June. The total cash flow, the cash in hand is about 45 crores, which includes earmarked FDs for our bank guarantees, which is 39 crores, and our cash balance in our bank is about 6 crores as of 30th of June. That's the first question. to address our Vashi property, we did get back the 2 floors that we had given for addition, the 3 floors. So our plan is to get this mortgage. So we are working on a working capital arrangement with the discussions are on the final stages with one of our bankers. So the plan is to have the working capital, get sanction done against mortgage of these 3 properties that we have got it from Avinsure Bank.
Yeah, just to add to that, Sanjay, in parallel also, we spoke about it. We are also trying multiple ways because, for us, when we started it, when we, the famous stuff, and I also saw some comments saying that, we got a debt-free company, 100 crores in cash and all that, we'll also try and put that FAQ up because this Vashi was also included in that, if you look at it from a planning perspective. As you rightly said, 50 crores was against that and we never got the cash back in our books and we just have the property. So fundamentally, immediately we are looking at multiple options. We are also looking at sell and leases.
Sure.
Yeah. So the purpose is that, Sanjot, so that, we are able to generate liquidity immediately. So that will answer some of the cash questions which have been asked because that's the concern for us and we are working towards that. We have to fix it to keep us moving. And second also is that since you asked it and maybe others might have similar questions, we are also trying to unlock the value of some of the investments we have made as well. Sanjot, as you know, you've been very closely following us. Some of the new ray products and platform, this year we are trying to unlock that as well. So that will also be a way to infuse capital because there is a lot of interest in the market for some of these products. We are now trying to see how we could, you would have seen that we have created some subsidiaries. We are now trying to see how we can unlock the value. So you will hear more of that. These are ways by which we want to infuse capital into the company as well. The third thing is the New Ray Bharat network, which is RailTel as well. To your point, Zach did speak about it. He did touch about it. To your point, Q2, now we are commercially ready, right? It's all ready and we are now building the funnel and closing it. We have a funnel of around 50-60 crores right now, Sanjot, and we are hopeful that we can close a few deals immediately. When I say 50-60 crores, these are annual contract values, okay? So because the advertisement contracts are for a year or some of them for 2 years, anything. And immediately we are focusing on the sponsors and the co-sponsor blocks. So we are selling off first the sponsorship, which is like a primary sponsor. If you look at if you go to any of our railway stations, you'll see that the banner which is there to say like a sponsored when you log in. And then the co-sponsors, those slots are being sold off. So that will take care of our break-even or our cost, fundamentally, Sanjot. So fundamentally, as I explained before, we have the minimum guarantee of 14 crores plus our operating cost. So if you're able to close these deals, that will be taken care for our this year's requirement. And all that other stuff which Zach spoke about will add to that. In terms of revenues which come from Google integration, already the first few dollars have started flowing automatically. Now we'll have to figure out how to get more better quality content and do that. And third, also monetization of content as well. So all this will start keying in. But our primary focus is to get our bread and butter sponsor and co-sponsor ads out of the way, Sanjot.
Yeah. Thank you, Thompson. I just have a last question about how the business looks like now. Considering situation in US and Europe. So, how the pipeline in UK, Europe, and US. You can just highlight how the big deals are in pipeline, or how are those wins or the number of deals you are working on increasing in US and Europe regions.
See, as I said, Sanjot, US and any of the Western geographies are a challenge. There are a lot of headwinds. But what we are getting is also, there are a lot of relatively challenger deals available. What I'm saying is what the tier ones are refusing to reduce or whatever it is, there is an opportunity for us. But that will be a problem, relative problem. Say, for example, a normal deal which might give a 40% GM in US, Sanjot, is available at 25% GM or 22% GM because the customer also wants to optimize. So those type of deals are there, but it's good enough for us right now. So we are focusing on some of those challenger deals, at least in our existing account. That is one. Right now, also I said we won a TCV of almost 2.4 million in in our existing accounts across various lines of business. So predominantly these are value businesses which customers are buying from us relatively, which are more higher priced by tier 1 players. But we make good margin in that relatively because they are definitely 35% GM and 40% GM relatively. So that's the trend which is happening. And we want to stay focused on replicating some of those offerings only, Sanjot. For example, just focus on credit union, focus on few areas and not spread us out thin. That is where in the Western markets. Definitely there's a big upside which is happening in the Asian markets. If you look at it, Asian markets are reviving big time. We are seeing huge traction. In fact, we have a renewed focus in our ASEAN territories as well because there's good focus happening in some of those territories. Middle East is also pretty good. India, of course, we are growing dramatically. The other one, Sanjot, as a strategy is we want to replicate the success of what Sushant and team has done in India globally. The DIM success, if you look at it, digital from and there is a huge opportunity for that in US and UK. This is stable business. The way I look at it, this is recession free. Though it will be margin is less, but we will get top line and decent 20-22% margin even in US and UK. So that's a strategy we want to replicate. Just replicate your IOCL, HPCL, all the wins we are happening globally, and there are a lot of people who are interested to look at that and optimize their cost in traditional business, Sanjot.
Thank you. I now hand over the call to Mr. Thompson for closing comments. Over to you, sir.
So thank you, everybody. And thanks a lot for all the questions. I'm sure there'll be more questions in your minds. But we are just in this format, we try to see proactively how we can answer most of the questions which has been sent to our investment relation team of EY. We are more than happy as we are building a more transparent, progressive organization. We are more than happy to keep communicating with our shareholders. We are more than happy to have smaller group conversations. I'm requesting EY team to facilitate some of these conversations where we can have a deeper conversation, share it for the benefit of the larger group of shareholders as well. So all these questions can be answered proactively, and I also want to thank for all the support and which all of you have had. I understand the pain for some of our long-term investors who have been with us right from the time of the company went through the CDR, the DRS, the various phases, the slump sale, and now I think we are all in the same. I keep saying that we are all repairing the plane as we are flying. I request your continued support for all of us as we can fix this plane and land it safely. Thanks a lot. Have a great month ahead and talk to you soon. Thank you.
Thank you. On behalf of 3i Infotech Ltd, that concludes this conference call. Thank you all for joining us, and you may now disconnect your lines.
Please subscribe and press the bell icon to never miss another update. Please like, share and comment.